Last week on April 2nd, the market went into free fall after Liberation Day and the reciprocal tariffs Trump imposed. The S&P 500 saw the biggest drop since 2020 and the largest consecutive three-day sell-off for the S&P since 1987. Just yesterday on Monday, China stated they will fight to the end if the U.S. continues to pursue the tariffs. Trump threatened to impose an additional 50% tariff if China did not scrap this idea. There's no doubt that we are definitely in a full-swing trade war now. Two of the biggest economies in the world right now are fighting hand-to-hand to see who wins this battle, and this could turn not just into an economic battle, but possibly a military battle, which certainly will have a negative effect on the economy. Many analysts now are cutting their year-end S&P 500 target to around 6,000, so not the best year for the S&P 500, all due to these tariffs imposed by Trump and the huge fear of a recession. A lot of analysts are also comparing this to the Great Depression, as large tariffs were implemented during the Great Depression, which just made it a lot worse for the economy during this time period. So the core CPI comes in this week with a projection of 2.5% year over year. Every time we've hit a recession, the CPI has tumbled downwards. If you look at the graph, we are almost at the level we saw during our last recession, 2020. That only lasted around 2 months, but we're only a few percentages away from that level. The last year, the CPI has been falling, and this, along with the bond yields I showed last episode, the rising unemployment, negative GDP growth, all strengthens my thesis into that we are in a recession. I explained last video that the average lag time for a recession is 7.3 months, so we wouldn't really know, but fundamentally right now, through all these economic indicators, there is a large possibility that we are definitely in a recession. So earnings seasons is in a couple of months, and there's no doubt that these tariffs and the downward growth that the economy is seeing right now is definitely going to affect a lot of these big companies. For the first quarter, analysts are now seeing growth of 6.7% for S&P 500 companies, down from about 11% when Trump was elected. Many investors are saying buy the dip. It's gone down this much, it can't go down much more. Well, that is a very false statement that some investors are creating in their head. I don't think that we are done with this dip, certainly, and China and America, some of these other countries that we've imposed high tariffs on, are now threatening back. Monday, we did see a little bit of a buyback from that large sell-off, but I definitely think that we're going to see some more bearish sell-off for the large indexes and companies. Most investors and institutions right now are very scared, and fear of a recession is still fresh in investors' minds. Many people are taking their money out of the stock market and putting them in money markets. They're just holding them as cash, much like Warren Buffett is doing right now with his huge cash piling, the only thing that is rising right now. I don't like this sentiment of buy the dip. I mean, first, that's kind of timing the market. I think really the best thing to do is dollar cost average. There's definitely going to be some more sell-off. The earnings season is not going to be pretty one bit, and that's going to create some more bearish sell-off. So dollar cost averaging is the best thing to do. Dollar cost averaging is an investment strategy where you have a fixed amount of money at regular intervals. So say I had $20 investing in the S&P 500 every month or every week, or maybe higher, 1,000. It really depends, whatever you're wanting to invest. But that is definitely the best thing to do right now. I think the most solid and safest investments right now are definitely ETFs. Trying to get into some of those larger companies could be definitely more tricky than just investing in a simple ETF. My favorite is the Charles Schwab US Dividend Equity ETF. Has an average annual return of 10% to 13%, so outbeating the S&P 500 and a lot of these other ETFs. Not only that, they have very strong companies, which will go up in price, depending if the market is doing well, and they have a great dividend. I did a prior video on my YouTube channel on that ETF, and I would definitely make sure to check it out. Another one is QQQM. This tracks the NASDAQ 100 index. It has a lower expense ratio of 15% than its equivalent of QQQ, which is a 0.20% expense ratio. A expense ratio is the annual percentage of your investment deducted to cover the fund's operating cost. So the lower the expense ratio, the better. That is for certain. I mean, also looking for companies that sell products that are necessities rather than wants. Could be in a recession, and people are not going to be going out to buy the brand new Nike shoes. They are simply just spending their money on necessities. So look away from consumer discretionaries. They're going to be hit very hard in the next up and coming months. Some of my favorites right now are financial companies or insurance companies. These are what some of the big institutions are investing in right now. One of my favorites is Bowhead Specialty Holdings, which is a insurance company primarily focusing on property and casualty insurance for big businesses. So overall, we're going to recover at some point. There's no doubt. The tariffs are going to become a norm. I think they're going to ease off at some point, hopefully in the near future, but only time will tell. Continue to dollar cost average in some solid ETFs that I stated, or just do your own research and find an ETF that fits your strategy. And you should see a decent profit/loss ratio at the end of the year. So that's all I got for you guys this week. If you want more breaking news or investment advice, please make sure to subscribe. New videos every week. Thank you for watching.